Okay, so the first week is done now on the 150 to £1,000 challenge. Great week, so currently up 115% on the account. So obviously those kind of returns are not sustainable or realistic with a regular account. But as I said, there's certain ways you can trade that will actually enable you to achieve those kind of gains in a manner that is, I say, semi-sustainable. But there has to be a couple of different things that you're doing, a couple of different variables you need to focus on. Primarily using the clock. You can't be just getting in at any random times. You have to be getting in at key market times where the volume is being trapped and then eaten into rapidly, because then there's going to be no pullbacks. It's going to be moving fast and hard, just slamming traders who are already in profit. So you can actually afford to up the leverage on those times. Over leverage is probably the better word than up the leverage. But yeah, because it's like they say, don't catch a falling knife. It's when the market is moving fast and hard. They've done the dirty work. They've done the dirty work. They've trapped the volume, and it's going to just move. So really getting in at the starts and the ends of 15-minute candles, hourly switchovers, 4-hour switchovers, even better. I know for GMT it's 6 a.m., 10 a.m. and 2 p.m. because then you've got 1-minute traders, 5-minute traders, 15, half-hour, 1 hour and 4-hour traders all coming into the market at the exact same time. So we have to imagine that when each candle closes, there is millions of traders sat there waiting for the result of that candle closure to then basically choose whether they want to buy or sell. So you have all these people out there who are deciding they haven't got setups, they haven't got, even if they do have setups, they're still waiting for candle closures to enter their positions. But basically on the candle closure times, that is when we're going to see the fast moves, fast and hard. So if you're going to be pushing the account to its limits, like I have been doing, then that's a given. You have to use the clock. So as I said, only getting in on 15-minute intervals, etc. The next thing is to basically stick to the outside. So price is always in a box. And basically, so there will be a high and a low, and again, the market's fractal, so there's prices in multiple boxes at multiple times. At any given time, it's going to be in a weekly range box, an hourly range box, a monthly range box. They're all different boxes, the prices with inside, but depending on what time frame or how far you plan on holding this trade for, you need to wait for price to breach one of the sides of that box and then have a given reaction. So price will only ever do certain amount of things. Like you can only do the same way price can only go up or down, it can only go up, down, or range. Shout out to Stacey Burke for the old 3 things markets do. But basically sticking to the outsides just means that you're wrong at the last point. So it means if you're just saying this is our range that we're working in between, we want to wait till price breaches either the top or the bottom place our trade, because anywhere in the middle it's just chop. It's just the matrix. They're just building up order flow. It's going to be creating higher highs, and then it'll break structure. Could even break structure then to the upside again. So it'll just be fucking around, messing with traders, just confusing people, scaring people out of winning trades, getting people sucked into losing trades, all that stuff. So by actually sticking to the outside of the box, if our bias is short, we want to wait till it breaks the top of it, pulls back inside, get an engulfment at a new hourly candle, even better, then our stop loss is literally 1 bar. So we just have a 1 bar stop, and the timing is on our side. So that way we're not just massively over leveraging our account. We're keeping this market, if we're right, should move fast and hard. So we're actually only in our high leverage position for a small amount of time, because once it pushes down, we can actually cover ourselves straight away or close half our risk or whatever it is, whatever way you choose to do it. You're basically keeping yourself safe safer than just randomly over leveraging and pushing accounts to their limits. What was the last thing? That was it. Also, the third thing is just to target space. So by space basically means somewhere where there's no support or resistance to stop the market. So you want to wait for volume to actually be trapped. So you want to see a big pump up, you want to see a big impulse move, you want to see traders sucked in, you want to see some imbalance, whatever way you want to look at it, you just want to see a big vertical move basically. So once we see a big vertical move, then the trapping process initiates. So they're going to be moving price up and down. Again, just fucking about, but we are just targeting that point of space. So after we get that liquidity interjection that leaves the order block or it leaves the imbalance, it is the pump, it's the whatever you like lingo you want to call it. Once we get that and then we consolidate above, that's where the volume is going to be trapped. So once they've locked in the high, when they come back down to that space, it's going to move again fast and hard. So by combining the timing with the staying on the outsides and then also targeting space, it's basically giving us three metrics that all coincide with the market moving fast and hard. So if the market's moving fast and hard, that means that we actually have the ability to hop in with a bigger position size because we're not anticipating, if we're right, the market to give us too much heat. So that way you can actually grow small accounts. Obviously it takes time to learn when these market conditions are, but those are the three actual factors to be looking out for.